Here we go, as promised. And I will officially kick off session 3 of Money Matters, aka More Investments. And before I hand it over to Bill, I will express my gratitude that we're able to gather on the shared unceded territories of the Squamish Nation and the Lil'wat Nation. Some of us are here in person, some of us are on Zoom. Welcome to everyone. Zoomers, you're welcome to submit questions via the chat feature, and Bill will check in periodically. Am I correct?
Checkpoints. I like doing checkpoints.
He'll check in periodically to see if there are any questions, so you won't have to hold them all until the very, very end. And that is it from me.
Okay.
Bill, take it away.
So last time on Money Matters, we talked about taxes, we talked about stocks and bonds. Now I want to talk about a few ways in which you can either, if you're not interested in directly investing in stocks, bonds, and things like that, how you can bundle things. And I want to start our conversation talking about mutual funds and then tell you never to buy them, and exchange traded funds. So they've got all these initials, like another new one is NFT, non-fungible tokens. Don't buy them. I just heard a story of a guy who paid $1.2 million and tried to resell it and couldn't. So I don't know what we're talking about. A mutual fund, though, is a collection of stocks or bonds or other types of things, and it is completely managed by a money manager. And so you can buy funds that are, for example, banking funds or financial funds. But the idea of a mutual fund is that they are actually managed. Now, they were very, very popular. They used to be very, very expensive when they started out. But even today, there's still mutual funds in existence. They are slowly being pushed aside by what I'm going to show you next. So they are managed by fund managers. And there is a new one that's a hybrid. The nice thing about mutual funds is that, one, they are very readily available. There is somebody with a mutual fund license in almost every bank branch you can imagine. Secondly, you can start with very, very small investments. And for many, many years, that was impossible. You couldn't do that because you had to buy stocks and you had to buy a portfolio. And this way you can buy diversity in a portfolio, because that's one of the things we want. We don't want to put all our money into just one stock, especially if it's Netflix. If it did, you became very poor today.
Really?
Oh yeah, it dropped 35%. The revenue dropped. I knew it was going to happen. As soon as they raised their prices, they're getting to the point where people are going to go, you know what? I can buy Amazon Prime and Disney for the same price as Netflix. And I knew that last price increase was going to do it. So with a mutual, you've got some stocks might go up and some stocks go down, and that's what we call diversification. So you can buy specialty mutual funds. So I've got an old one that I still have in my portfolio. That's a Royal Bank of Canada income fund, and it's done okay. I bought it as an experiment just to see how well compound interest could work over the long run, and I got about 7%. So it's doubling about every 10 years, and it's done okay. I have cashed some of it in to make some other investments. The fees are very odd in mutual funds, and this is why they're becoming very unpopular now. Some are just, you pay a fee and they take it out of your fund, and that's the MER, the management fee for the fund. And some of them had funny things like front-end loads, and then some had rear-end loads. And that just can take a big chunk of your money away. And that's one of the reasons that they've really gotten rid of a lot of the front load and rear loads. They're pretty rare now. Some of the legacy funds may still have them, and might still have money in that, because for years that was considered the only way for a small investor to invest. They are very out of fashion right now. I do not recommend them. And the only reason a lot of financial advisors recommend them is because they have mutual fund licenses and they don't have stock licenses or ETF licenses. And so you've got to be very, very careful who you choose. Always ask about the fees, because those fees will eat up at your capital. And even if it's only 1%, over the long run, the difference between a 7% return and an 8% return is quite substantial when it comes to your long-term investment. So I've got a graph, and which one did I pick? Oh, this is the RBC Balance Fund, and I compared it against the TSX 60, and you can see that it follows the 60 quite nicely. The TSX 60 is the top largest stocks in Canada, 60 top largest stocks as measured by capitalization. Remember what capitalization is from last time? I know it wasn't on the exam. Capitalization is the price of the shares times the number of shares outstanding. And that's theoretically what the company is worth, but no company is actually worth that because you couldn't sell all the shares for cash. So even though we say Elon Musk is so rich, he's actually not as rich. Don't get me wrong, he's not going to miss a meal, even though he is homeless apparently. But he's not going to miss a meal, neither is Jeff Bezos, even though their stuff is tied up into very few. So you can see that over the long run, you're sort of getting the same return, but you're not having to buy all 60 stocks. So it's a good concept, and it was a great concept for the longest time before computerized trading became popular. For this same fund, in this example, it's a no-load fund with the total MER of 2.36, and the management fee is 1.85% of that. That's a pretty big chunk to be taken out. That being said, if you're dealing with a broker, quite often it's not unusual to pay close to 2% of your asset value to the broker for managing your portfolio. There's two models you can typically use with a broker. They can either take a percentage of your portfolio and charge you every month, or they charge by the trade, or it's a combination of both. I prefer them not to charge by the trade because that gets into this whole notion of trading rather than investing. And what I'm talking about tonight is investing. People that are buying and selling stocks on a regular basis, some stocks in fact you buy with the intent of selling quickly. That's trading, and you can make lots of money in trading. You can lose lots of money in trading. I recommend for the long run that people become investors, but there's nothing wrong with trading. In fact, I heard a fellow on Business News Network the other day, and he referred to any energy stocks. He says that should be for trading, not for investing. And that includes large companies like Canadian National Resources. So, which is a very, very large oil producer out of Alberta. My preference for most small investors who don't want to be buying individual stocks is moving over to exchange traded funds. And what the exchange traded fund is, it's just an algorithm. And so there's not as lot of thinking that goes in, or as much thinking that goes into it. Now, some exchange traded funds are a little bit more like mutuals in that they're highly managed exchange traded funds. In Canada, the leader in exchange traded funds is Bank of Montreal. They got into it first, but Scotia iTrades, they've got exchange traded funds. And I think RBC bought BlackRock. They were late, very late to the game. Very typical of RBC. They tend to come in late, and then they tend to come in with better stuff. Like their ATMs were always a little bit behind, but they were a little bit better. As opposed to BMO, they came out with the first ATMs in Canada. The same is true of the online banking. They were kind of behind, but when they came up with the latest version, it's got some really nice features. Between you and the lamppost for trading, I'm a big fan of TD. I think that the TD app is a really nice app, but I've used TD, I've used Bank of Montreal, and RBC. And you know, it's like phones. There's something I like about all of them, and there's something I don't like about all of them. But I have found that it's easy to navigate. By the way, if you just want to play at this, all of the banks, I know RBC has this for sure. You don't even have to open a brokerage account. You can open a dummy account and you can play. Maybe that's what we should do when we do next year, when we do the 4-part series next year.
Yeah.
We should start out and have everybody open a dummy account, and everybody has $1,000. We'll see how well you do by the end of the course, just for fun. That'll get you looking at things. Maybe we'll give you $1 million. What the heck? If it's pretend money, doesn't really matter. You know, we'll call them whistle bucks or something like that. You know, that's maybe what we'll do. Now, I like exchange traded funds because they're similar to mutual funds, and they can either be a basket of everything. So when somebody says to me, I don't know what to do, what should I do? And I want them to start doing something. My go-to is say, look, if you're lazy, put everything into VOO. Open up a US account, put everything into VOO. VOO is the Vanguard fund that has the lowest fees ever. And you're basically buying the Standard & Poor's 500. And that's how they, and every once in a while, I think they do it every quarter, they balance the funds, so you've got the right amount of stuff in the right place. They're basically betting on the entire US stock market. There are very similar funds in Canada. I believe BMO, don't quote me on this, I believe BMO has a TSX 60 type of fund. And effectively, it's just an algorithm that buys it, it balances it. So, hey, Royal Bank went way up, we've got too much Royal Bank, let's sell a little bit of our Royal Bank and buy something else. It's called balancing the fund. Two that I really like is those 10 I'm an income investor. I like to see the money coming in every month. It just makes me feel good. Not that feeling should matter. What is this?
We're only human, Bill.
What does Kevin O'Leary say? He says, don't love your money because it'll never love you back. I dated her. No, that's another story altogether. Wendy, that's different. So the thing I like about them is that there's a theory in investment theory that says if you're playing in the same pool of stocks in the long run, you won't beat the market. And so if you're not going to spend time researching and working and trading and really doing your thing, you can buy, if there's a sector you like, you can buy into that. Now, two of the ones that I like are kind of neat because they have a thing called a covered call overlay. What they're effectively doing is they're selling call options and they get money for the call options. Stock goes way up, you don't get the full benefit, but you get more money every month. And it's a great way if you're retired to get a good return on your investment and it goes up. And so my two personal favorites for that are one called ZWB, which is the Bank of Montreal covered call for banks, and ZWU, which is the same thing, but it's utilities. So they tend not to go up a lot, although they've been going up a lot lately, but they pay a nice monthly combination of dividends, capital gains, and return on capital. There's another thing I like for that called real estate investment trust. I'll talk about that in our real estate section. They're way lower than mutual funds, and you can buy stock and bond funds. So you can get something that you like, and there's everything. There's green funds, and then there's I don't know if there's any like exploitative funds like that only carry armaments companies, oil companies, cigarette and tobacco. I don't think that exists, but maybe it should. I don't know. But the point is that it's an easy way to invest. And this is a great way for you to build wealth slowly over time. You can take something a bit more aggressive. I took one, I recommended it to a lot of people. Actually, a lot of people, of course, took it, did really well. Don't buy it right now. It's the tech stocks. It's called QQQ. But that was a good one for growth. And so if you're younger, you can take these riskier ventures, or you can add just a little bit. But I'm a big fan of some of these, and especially with the covered call. I just love those a lot. And you can get very good returns that are tax preferred because they have dividends and capital gains, which, if you recall from last time, do not have the same level of taxation as interest or self-employment or rental. So again, you can see the same thing. This is the BMO SMO's composite index, and again, it's effectively just following the market. But the big difference is the MER, and what you're paying them to run the fund is fundamentally lower. So if you're a small investor, if you don't have a lot of money, let's say you've only got, even if it's $100 a month, you can set up your own account with Wealthsimple, any of the banks, and in fact, with some of them, you can buy exchange traded funds without fees. You only pay fees if it's a stock. Questrade is another one. And you can buy them and just hold them and put money into them. And it's a great way to get into systemic savings because that gives you what's called dollar cost averaging. And so when it goes up, you buy a little bit less. When it goes down, you buy a little bit more, it averages out. And it's great. I learned about dollar cost averaging, by the way, from the Wealthy Bargain. which I think is a terrific book. I am not a big fan of Rich Dad Poor Dad because it's a bit more American in its orientation. But I'm a big fan of Chilton's The Wealthy Barber. I think he does a really good job of explaining things to people. The difference is in that example is it's got a dividend yield, no load, management fee of 0.05 and an MER of 0.09. Why? Because the computer does all the trading. They don't pay a lot of commissions on exchange traded funds. Most people buy them on their own. And so the cost of customer acquisition is fundamentally different. So when you're talking about stocks and bonds, you really need to have a lot of, at least my recommendation is at least 300 to a quarter or to $500,000 to buy individual stocks, unless you're trading. If you're trading, all bets are off. But I mean, to buy and hold, you want that diversity. You can get that diversity through exchange traded funds and mutual funds. And remember, I cannot sell you these things. So I make nothing from this. I just give you tips that I think are really important. And it's really important to know that there's no right thing to do because it depends on your situation. Should you, pay down your mortgage or should you invest money? That depends on a lot of different factors. I mean, I've got a friend that's convinced that he's better borrowing against his mortgage for some high yield funds that are tax preferred. And I've got other people. Personally, I don't borrow. I'm going to show you how leverage works, by the way, just for fun. But I personally don't, and it's not rational. I know some very rational plays that involve leverage. I just don't want to do them. I also don't know that, at my age, that's a really smart thing to do because you never know what's going to happen in the long run. Although, as John Maynard Keynes once said, in the long run, we're all dead. Now, let's look at some other, because we did talk a little bit about stocks and bonds last time. I want to talk about other forms of investing. And one that's very popular is real estate. Personally, I think real estate in the big picture is a great investment, but timing is everything. Right now, I'm not convinced that real estate is a great investment right now. That doesn't mean I'm anti-real estate. It's like buying a stock. There can be a great stock, but if it's too expensive, it's not a good investment. It doesn't mean it's not a good company. It could be a wonderful company, but it may not be a good investment if the stock is too expensive. It's the same thing with real estate. Real estate is becoming incredibly expensive. And if the Bank of Canada does what I think the Bank of Canada is going to do, and just about everybody on earth thinks the Bank of Canada is going to do, we could well see a real estate correction. I hope it doesn't go too high, because for all of those people that say, baby boomers had it lucky, they've forgotten what happened when interest rates skyrocketed to 22%. I have friends of mine lost those. Yeah. And I think that the Bank of Canada and the other central, I don't know, Tiff Macklin does not call me on a regular basis and ask for my opinion. But I don't believe they're going to jeopardize the entire economy just to control inflation, which is created from a number of different non-economic circumstances. It's a weird time, and Putin just made things a heck of a lot weirder economically. There's supply chain issues, there's pent-up demand. Raising interest rates only diminishes demand. And there's been some pent-up demand because of the pandemic, but it doesn't affect supply. And a lot of the inflation is caused by some supply shocks. So I don't think it's going to go back to 22%. That said, I'm fairly confident that we're going to see a 50 basis points, that's 0.5% interest rate increase. And that's what everyone is saying. Now, everyone, by the way, got it was on 2 days inflation numbers. Every analyst got it wrong. All the economists, the Bank of Canada got it wrong. It was higher. It was 6.1% on an annualized basis today. Nobody saw it coming. I think what's happening is people are taking advantage of the fact that there's inflation, even if they don't have cost changes, they're taking this opportunity. And a lot of businesses are saying, look, we lost so much money during COVID. we've got to make some of it back. And I think you're seeing a little bit of that, maybe a lot more than that than I originally thought. That's why I'm not a fan today of real estate. And I'm not saying, so, I doesn't like real estate. No, I love real estate. I like all forms of investments, but it's always appropriate in the right time, in the right place, and you've got the right objectives. So there are a number of different ways to invest in real estate. There's the good old, buy it and flip it. And really what you're doing is you're buying it, hoping you're getting a deal and you're going to sell it later on. And some people say this is driving up prices. I am not convinced that it's having a major impact. But it's the one area I'll actually say I agree with Jagmeet Singh is I don't think a buy and flip in less than a year that you didn't live in the house should be considered a capital gain. I think that's pure and simple. I think that that one I'd change in a heartbeat as opposed to moving capital gains. He's right. Sometimes what people do is they buy a piece of property and develop it. Now, to me, though, there's an investment component in that because the land price is variable. That to me is more being in a business. And you really have to know what you're doing to be a good developer, because you have to know all about zoning and going to city council, because if you just put what they want you to put on it, you'd never make any money. So you negotiate back and forth with the planning department and you make a deal. Well, if you give us this, and we'll put up a statue, Jeanette, and in the plaza here, so we can look at you when we're doing our. I don't know whether that would be something we probably.
Never say never.
But they get improvements for the municipality, or what they've been doing in Vancouver is, if we let you build more, will you contribute money, or will you make sure there's some non-market housing, that kind of thing. It's a really difficult thing. Then you have to manage the construction, and then if it's say a condominium complex, then you have to sell them, or if it's commercial, you have to get them rented out. It's a business.
Мало вийшли. Аріда.
Нічого оставить. Tamam.
Hold the phone. Okay, I'm muting everybody. Okay.
That's scary.
Please continue.
But here's real estate, and this is one, and it's very interesting. They've done studies in Canada. A lot of people have second properties, but a lot of people's second properties are actually part of the rental pool. In fact, they make up a really big part of the rental pool, especially here in Whistler, where we don't really have non-condominium apartment buildings. Somebody told me there was one. Forget that, outside of Staff House. I think there's one at Creekside, right past Gondola Village. Somebody told me that was built for purpose rental. Those are not condominiums. Most of the development up here in Whistler are individually owned condominiums. Good heavens, even the hotels are individually owned hotel rooms as part of the overall model. And so when people put that, because I've done that, I have bought real estate specifically to rent it out. And when they stopped building apartment buildings, they really stopped in about 1981. That small and pop non-building, which is like one apartment or two apartments at a time, is actually an important part of the rental pool. So I don't really kind of get why that's being kind of like put down. I don't understand why they think that's buying and leaving it empty to flip it because you've got money offshore. That's a different thing altogether. That's not what I'm talking about. I'm talking about when you buy, rent, and hold. Now, the nice thing about real estate is banks love to finance real estate. And I love telling this story. I was dealing with a fellow, and it was at Bank of Montreal. Not that anybody else would be, any different, but great guy, really knew his stuff. And I said to him one day, it was my mother banks, and I was chatting. I said, I had a question for you. I said, if I were to purchase an investment property, how much would I have to how much would I have to have as a down payment, and how much would you lend me at first mortgage rates? And he said, oh yeah, it's easy. I'd lend you 80%. So he said, if I were to buy the same amount of money in BMO stock, how much would you lend me? I think it was 50%. And I go, just a second now. the dividend return on BMO stock is higher than the capitalization I would get from the apartment. There's no carrying costs with BMO stock. I have to pay taxes, have a tenant, do some work. I make more money after tax with my dividend return from BMO stock. And yet you're telling me you have more confidence in the real estate market than you have in your own company. And he looked at me and he went, I never thought of it that way. But for some reason, there's a psychology that real estate is a good investment and therefore it's got a lot of security. Remember, we talked about banking, we talked about the importance of security. And banks seem to be able to lend money, as do other alternative lenders. Mortgage brokers can find you private placement money, but that seems to be a lot easier than the traditional formula that they use for leverage when you're buying stocks. I will show you that in a bit. But because of leverage and because of the ease of getting money, no, very few people will come to Whistler and spend $1.8 million on a condo for rental or a townhouse for rental and pay cash. They will borrow money against that, and that's part of the calculus that they do. The final way, and I didn't have this in notes before, if you want to play real estate and you don't want to take as much risk, you can buy into what are called real estate investment trusts. And after exchange traded funds, especially income-based exchange traded funds, I'm a fan of them. I would hold up to 20% of that because it's got some of the advantages of real estate, it's got some of the advantages of bonds. And you can buy real estate investment trusts that are office buildings, residential buildings, all kinds of stuff. I'm a fan, but you can research those. So let's say, and I obviously wrote this exercise quite a while ago. We bought a place here in Whistler for $300,000. Today, that would be a parking space. We're going to put $15,000 down, or at $15,000 for taxes and closing for $315,000. We put a down payment of $94,500. We mortgage $220,500 at 3%. Here's what my expenses look like. And you can see the expenses on the board. We've got our property taxes, our strata, repair and maintenance, tourism, Whistler, interest. And so in this example, we make a profit. We make a profit. And that's only, $18,000 a year. That was $1,500 a month. Now, again, it'd be pretty hard to buy anything that inexpensively these days. But back when I did this example, you could buy a place in Gondola Village for about $300,000. So here's the cool thing is you make a net profit of $2,884. However, when you pay your mortgage, you pay principal and interest. And with low interest rates, the one downside from an investment point of view to low interest rates is that you're paying a lot of principal with your interest. And principal is not deductible against the income generated by the apartment. So in this example, you have negative cash flow, and at a 29% tax rate, you'd actually pay an additional $836. So you've got negative cash flow of $4,000. So you're coming up with $4,000 every year just to keep this afloat, even though it's not losing money, and it's the principal payment. But remember, you're paying down the principal, that's like money in your pocket. But it does have negative cash flow. If you do not have the ability to finance things like somebody's not in the apartment for a while, a special assessment, things like that, real estate can be a disastrous investment. Real estate investing requires patience and timing. If I have a stock and I'm forced to sell it, I can sell it and get my money tomorrow. If I'm forced to sell real estate, it takes a couple months to sell the real estate. Because remember, just because in the last little while we've seen a market in Whistler where things are sold before they go on the market. Just because we recently seen that isn't forever, and that isn't the norm. I'm lucky because I'm old enough to have seen things go up and down, and things do change. That's the problem. Everybody thinks when they make money in real estate, everybody can make money in real estate. You can lose money in real estate. People in Whistler have lost their shirts in real estate. And believe me, there are people that have purchased recently, and I hope they weren't investors, that probably paid more than they should have because of that FOMO, that fear of missing out. Sometimes the best investment strategy is knowing what to say no to. Again, I'm a big fan of real estate as an investment, but just because I'm a big fan doesn't mean I'm a big fan now. And it's very important that you know your timing and your needs and your goals. The other thing, and funny because somebody, oh my, I think it was my son, was asking about, you know, should I, Bill, usually, Dad usually. Bill's his grandmother Eileen though, that's really odd. He said, you know, you and I should do a real estate deal. I said, you know, I don't want to. I don't want tenants. I don't want the hassle anymore. Like I say, you know, if you buy shares in the Royal Bank of Canada, you know, they're going to pay you your quarterly dividend. They're really good about that. You're not going to have to take them to the, and my shares in the Royal Bank of Canada never upset the neighbors. I don't have to find a new bank because RBC probably, if RBC is going someplace, we've got way bigger problems. Our banks are older than our country. So there's that, but, you know, and especially if you're handy, I'm not, I have the one tool that can fix everything, Visa. But if you're handy and you can do some fixing up, if you can do your own repairs and maintenance, if you've got that ability, and you put some sweat into it, it can be really good. Or you just have to buy and manage fairly well. Over 5 years, you've invested, including your losses, about $114,000. And even if the value of the property only went up by 4%, because of the leverage, you're going to make $51,000. And your return on investment is based on what you've invested, not based on what the capital appreciation of everything is, because remember, that was being financed by somebody else. This is only an increase of 1% over your interest rate. A lot of times, real estate goes up way faster than anything else. And that's why people make a lot of money. In this same example, over 5 years in Whistler, if you bought it at the right time, that apartment would have been worth $600,000. They were doubling that. Now, what happens when interest rates go up and it goes down? Well, if you can hold it and you're still getting the rents, you've got the time to wait. But if you panic and you have to sell something, that's where people get absolutely hammered. Because remember, you have to pay real estate fees and things, closing costs when you sell real estate. I have to pay $9.99 when I sell my shares in the Royal Bank. I don't know a lot of real estate agents that would work for $9.99 a sale. It doesn't work that way in real estate. And the reason I tell people is everybody says I'm really negative because I'm really negative. No, it's because I'm gonna tell you a little secret. Don't tell anybody I told you. Maybe we should beat this out of the YouTube version of our session today.
The secret.
And maybe this is just guys, because remember, generalizations about women are sexist, we will not tolerate them. Generalizations about men are merely observations of the way life really is. When people tell you how well they're doing in their investments, they're only telling you about the good ones. They never tell you when they messed up. And so when we hear stories, and this is where anecdotal evidence is quite dangerous. We hear stories and you go, and then you feel like an idiot. Oh, I'm stupid, I should have done that. I didn't know that apple was going to fall that far from the tree. Well, most people didn't. Most people missed out on that. And they never tell you the story about losing their shirt on the next investment. They only tell you the good stories. So we're under a false impression of this, and it appears after the fact, I did this and I made money, therefore there was no risk. And what I'm saying is there is risk to every investment. There are rewards to every investment, but because you've borrowed money to buy an asset such as real estate, if my property value, you know, I've got a 20% down payment. If my property value goes down by 10%, I've just lost 50% of my investment because it's all legal, because it's borrowed money. And we had an apartment that went leaky condo-wise. And the assessed, not the appraised value, the assessed value dropped to by about 80% of what we paid, to about 80% of what we paid for. And I honestly never thought we'd get our money back. But fortunately, we were in no hurry to sell. we were able to finance the special assessment. It cost, came out of our pocket, it's $30,000 out of pocket. Fortunately, that's tax deductible when it's an investment. But still, I mean, people, wow, it's tax deductible. Yeah, and that's like paying $30,000 to get 10. Eventually it turned around. We waited long enough, we got our money back, and we made a good profit. But if we were in a position where we didn't have the money and we had to sell that apartment, then somebody would have picked that up and they would have really done well. You've got to know what the risks are before you purchase. It's not so cut and dry that everybody's doing it. It's not like watching Channel 29 and Skippy and his wife go in and make things beautiful and make a lot of money. I don't think there's a Skippy, actually. I just made that up.
Maybe Skip.
Yeah, there's a Skip. There's a guy. There's a Skip. There's a Skip Wilson. Yeah. Anyway.
Are you telling me those shows are not real life?
They're not real.
But they're based on reality, and yes, you can make money. It just kind of irks me that they never show the episode where somebody loses their shirt.
Mhm.
Because they make it appear easier than it really is. And the key to what a lot of them, and some of them do really well by really buying rundown properties, and they know what they're doing from a construction point of view. The only way to make a boatload of money in most markets is to get a deal. And in this market, it's hard to get a deal. So again, I'm not saying abandon your desires to be the next real estate mogul of life. But I am saying that it's not as cut and dried, and it's not this no risk investment that, frankly, it has appeared to have been thus since about 2011, 2012. It's had such a good run. Everybody thinks it's always going to happen. And one of the things we know is life goes in, sine waves. And I would advise caution, but then I've been told I'm too cautious. So, if you make a lot of money, Bill doesn't know what he's talking about. And if you lose a lot of money, you should go, it's still Bill's fault anyway. It always is my fault. They're going to rename the San Andreas fault after me. It's all Bill's fault.
Bill, we have a real estate investing question.
Yep.
Are you ready to
Absolutely.
okay. So one of our friends on Zoom asks, so REIT, which I guess is Real Estate Investment Trust,
Yep.
has a lower risk than buying a house for the investment, but buying a first house should be considered.
Buying a house is not an investment.
Mm.
The house you live in is not an investment, even though it has some tax implications. It's the place you live. I'm talking about investment in second properties, but you're absolutely right. And the reason that it's great to get into a home is, one, it gives you some tummy comfort. I mean, and it breaks my little heart every time I hear the story of, I was in this, secondary suite for all these years, and the owners finally, it just got too expensive. Of course, the property taxes go up. The Whistler part's still fine, but the rest of the product stuff becomes onerous. And people have sold their places, and a lot of the folks that are wealthy enough to purchase in today's, they don't necessarily want somebody in a secondary suite. And so I know a lot of people who have lost their housing here in Whistler because they're in a secondary suite. Not that I'm against secondary suites, but again, there's a risk. So purchasing as a first-time home buyer, and by the way, the government has put together, they've actually recycled an old program called the RHOSP, the RHOSP, and that was big when I was young. And what it is you can put money into this, it's tax deductible, and when you pull it out to buy a home, it's tax-free. So it's like an RSP for house purchases. So you don't have to do this stupid thing where you can borrow from your RSP. I never like that. I've told everybody I don't like that for your principal residence. And I tell you, if you do not have a home, a first home that you've purchased, if this thing, and I don't know if the budget is passed yet, but you're going to be allowed to save $8,000 a year tax-free to be purposed for purchase of your first residence. And you should be able to invest that in things like ETFs and things like that to let that grow whilst you're building up the wealth, and that's specific to homes. Unfortunately, if everybody does that, more people get into the market, they'll have more money, and that could actually have an upward impact on the price of housing, but that's another story altogether. So if that comes to fruition, which I believe it will, I think that the New Democrats will support the government on that. In fact, conservatives may even support the government on that. Minister Friedland, that was one of the promises she made in the last federal budget. I don't know if that's passed. So I don't consider your principal residence an investment, but I do consider principal residence it just buys you tummy comfort. My daughter got in early, and even though life was expensive, she is now paying less for a place to live than she would if she was renting the second one. So it gives you that tummy comfort, gives you that control over your life.
I have a question, if that's okay.
Oh, sure.
Um,
No, you have to go on to Zoom for the question here.
I have two siblings, and sadly, we lost our parents, and they had a house in Toronto, outside the suburbs of Toronto. We decided just emotionally that we were gonna rent it out
Okay.
instead of selling it.
Mhm.
This was, we made this decision about 2 or 3 months ago.
Right?
So now that I'm seeing all the stuff that's going on with do you think this was a bad decision, or should we have taken advantage of the crazy?
Okay, so in the long term, I have a lot of faith in both the Toronto and Vancouver markets because they're cities that are going to continue to have high demand in the long term. However, did anybody bother getting an appraisal on the home when you had it done?
We are in the process of talking about that. The person doesn't move in till May the 1st.
Doesn't matter, because when the probate of the will was settled, it crystallized the lifetime capital gain. So let's say that house was.
The house, what we did is, my dad passed first.
Right,
So we put my brother, who doesn't own a home, we put him on the deed of the house, so we took dad's off to save probate taxes. So my
Okay.
brother is technically now the owner of the house.
okay,
He doesn't live in it, but
Okay.
because he rents somewhere else.
right.
Um,
So from the minute your brother got put on title,
Okay,
that home is no longer a principal residence. Because that home is no longer a principal residence, from that point on, when you sell it, that portion is subject to capital gains.
okay, because I was living in the house for a while, so we were treating it as his primary residence.
Yeah, don't tell me that.
Don't put it on the thing. Well, it was only because I was living there, right?
And she didn't know.
No,
So, and again, when it's rented to, and now that it's rented, I would start at least for now, but get it appraised because you need to have an adjusted cost base when it does get sold. So that's why it's really important.
yeah,
You need to sell it.
I guess this is a little touchy subject, because I've talked to so many people who in Whistler, they own the property, but they're renting because their property is larger. And so, I have like 2 or 3 friends who own real estate that is 2 or 3 bedrooms, but they're renting it all out, and then they're renting another smaller.
But they
place.
don't own another place,
No,
they can declare that as principal residence, that's fine, because they only own one property.
well,
It's
they,
when you and your siblings own something.
we
it's-
don't
it's
own it, it's
exposed.
under my brother's name. So it's not my name, it's not
Yeah,
my
no,
name.
that's
it's my
fine,
sister's name.
because he bought it from your father, or your father's estate, who is
Yeah.
the principal residence. So now that it's being rented, it's no longer his, he's gotta see an accountant about that. The problem is going to be when he distributes that, but that may not be a problem, because we'll be able to have gains on it, if he's renting another place. If he owns another place, then all bets are off.
That's why we put his name
Yeah,
on
if
it.
you own another place, all bets are off. And I've seen people try to do that. In fact, I met somebody who tried to do that. He said, well, we're just gonna give our place to the kids to avoid capital gains. No, that's not the way it works. As soon as you give the property to your kids, that's capital gain. And it's.
Because the lawyer that we did this through, he recommended it so that we didn't have to pay capital
Yeah.
gains.
He recommended that so it didn't go through probate.
Mhm.
But if everybody rents it, then.
Well, this is a
yeah,
new thing,
Yeah,
right?
that's gonna trigger a capital gain. I personally, Personally, would never do that with siblings. I would have sold them anyway. That's just me.
Yeah.
That's just me. But then you don't know my siblings. They're wonderful people. They're absolutely.
We're all just lost here.
Well, and as we talked about earlier, we do still have feelings.
I know.
Yeah.
Many of us do, Bill.
Oh, that's your first mistake. Wait a minute. You don't even have to page it out.
We're still fine on Zoom.
I'm fine on Zoom, yeah.
And our friend on Zoom says, thank you for your answer.
You're welcome. So good. State assumptions.
Now might be a good time to say, if there are any other questions on Zoom, please feel free to put them in the chat.
Well, you can chat anything. So we've talked a little about mutuals, we've talked a little about ETFs, we've talked a little about real estate. Any questions on any of those things before I jump into some of the tricky stuff?
Yeah.
Back in the day, they could put it all into a trust and they changed the rules.
Yeah, I was just thinking as well, because I'm with Edward Jones.
Mhm.
And
Good company.
it seems to be like, you know, we have the same set, I guess it's mutual funds that we're in. And then,
Edward Jones can sell ETFs.
yeah, I'm not too sure, because I didn't know the difference between the two
Yeah.
until this second, until
Yeah,
tonight.
yeah, if your investment advisor has you into mutual funds, I would really strongly ask why, because for every mutual fund, there's so many exchange traded funds today with lower MERs that.
Okay, well, I'll ask
Yeah.
them about that, because it might be, I just assumed.
I mean, there are some specialty mutual funds that play different markets, like but even they're giving away to ETFs. They're going away the door. They really are. Because exchange traded funds are just so much more efficient and so much cheaper. In fact, a couple of years ago in Canada, and Canada was a great place. We loved our mutual funds. ETFs overtook mutual funds several years ago. Again, risks and rewards, there's often good cash flow in real estate. It's easy to finance, and I tell you, when the lever works in your favor, you can do extraordinarily well. And remember, when you sell it, it's a capital gain, so you're actually paying less income tax than you pay on earned income. You only pay income tax on 50% of the capital gain, and that can be really advantageous. Unfortunately, if you lose money, you can only write it off against the capital gain. Vacancy can obviously affect cash flow. You always, if you're buying to rent, this is specific if you're buying to rent, buy in an area where you know you can get a tenant. By the way, I've heard some horror stories that happened with respect to COVID. I just read an article, like a fellow bought a farm just outside of Toronto. And the tenants just decided not to leave. And then COVID ended and they just decided not to leave. And so they went to the landlord tenancy branch, and there's so many problems, it's so backed up. They've owned the property for 11 months and they can't even get onto their own property. But, you know, the landlord tenant legislation, in my opinion, is really pro tenant. If a tenant really wants to be a pain in the butt, they can make your life miserable and you can't do anything about it. Costly liquidation, and of course, you've got to be able to hold up. If it's a real estate, remember I talked about a real estate investment. Even though your home can be an investment, and there's lots of things that are good about owning a home, I'm a big fan of home ownership. I'm specifically talking about investing for wealth, specifically. So I'm not like, you notice I just stand up here and say, real estate is for everybody, buy real estate, take my course, how to buy real estate, make a lot of money. I want to be balanced. And in fact, I'm probably a little bit like this. I want to give everybody the risk story more than the reward story, because I think there's a lot of puff out there. And so maybe I'm trying to balance things back.
We have a capital gains question from Zoom. Here's a scenario.
Okay.
A house was rented for 20 years.
Yep.
And then the owners moved in
Yep.
and lived in it for an additional 20 years.
Yep.
How is the capital gain calculated if it is then sold after those 40 years?
Excellent question. So what you would do is you take when it was purchased in year 1, have it appraised in year 20. That would be subject to capital gains. From year 20 to year 40, that would not be subject to capital gains. There are exceptions to the rule. By the way, if it was long enough ago, there is a portion of that period of time, that takes back to the 70s. How old am I again? There may, okay, this is tricky. If part of that period was prior to 1971, it may be 1971 until parents moved in, and then that's tax-free, because capital gains, I believe, came into existence in 71. Don't quote me on that.
Well, 40 years ago was 1982.
Oh, well, then don't worry about it. Shoot, I'm old.
If we're talking about a contemporary example.
Yeah, if we're talking about a
here.
contemporary
Yeah.
example. Every once in a while, there's some house that goes back so long that there was a change in the capital gains when we first brought in capital gains. For many years in Canada, there were no capital gains taxes. There were no capital, and it became a real issue for people with summer cottages. They did what they call crystallizing the capital gain. So in that example, the period for which it was a rental would be subject to capital gains. You crystallize it and say, okay, my adjusted cost base is there to there, and then from here to the end, it would be subject to your principal residence exemption from capital gains.
Right.
If I'm not mistaken. I'm not an expert in the tax, but I know my way around. I get about 90% of the answers right. If it's a super tricky one, I would defer that to probably a specialist accountant.
That did kind of sound like an exam question.
Yeah.
Yeah, that one, yeah.
Bill is traveling down the road, buys a house at.
Real estate investment trusts are wonderful, especially if you're an income investor. So you can put money into the bank and get 2%. I can put money into SOT, and the last time I looked, it was about 6.5%. It's been going up like mad. SOT is office buildings, but they do a lot of office buildings that are like government office buildings. But Slate has residential. If you want real security and capital gains, put your money into warehousing. The Amazon effect has been just absolutely phenomenal when it comes to warehouse space. So you can get office, you can get industrial, you can get residential, specialty. Northwest Healthcare Trust. This is an absolutely well-run, fantastic, all over the world. Everything from old folks' homes to doctors' offices and clinics. That's what they specialize in. A nice dividend, and over the last few years, it's risen quite a bit. I'm wondering if it's not a little pricey, but unfortunately right now, it seems almost everything's pricey. I had a conversation with my buddy today about that, is what should you do with money? Right now, it's really hard to know because the TSX is not that far off of its all-time high. And the tech stocks seem to be tanking like crazy, especially Netflix. So we go home watching Netflix. Oh, it just got hammered.
I didn't know.
It got absolutely, I mean, it's come off like crazy, but it got, when not only did their subscriptions go down a lot, then they found out that the revenue went down. And I thought it was going to crash after the next price increase went over $20, but apparently people are saying, forget this, and they are canceling in droves. They're actually talking about having a cheaper version that has ads.
Oh, I saw that today.
Yeah.
Mhm.
And that's why. Yeah. But, and then Elon didn't have any nice things to say about them today on Twitter. When does Elon have anything nice to say on Twitter? He's an interesting character. So sometimes what you can do is you can borrow money to buy stocks or ETFs or any form of investment. And so here's some examples where we've got an investment of $1,000 and you just pay it, right? You invest $1,000, it yields 3%, goes up, stock price goes up 5%, you're up 8%. Because you didn't leave it. First, the top example is not. Second example, it's 50-50. You borrow 500, you invest 500, same thing happens. But because your borrowing rate is lower than the return, because the total return is 8%, the borrowing rate's only 4%, you invested $20 and you got $60 back as a 12% return because it's divided by the $500. Because you only invested $500, you borrowed $500. Now, the beauty of this is that if that yield is a dividend yield, you pay less tax on it, but you get to write off the entire amount of the interest. And you don't pay any tax unless you sell the stock because you have a capital gain that's unrealized. So there are some real tax advantages to buying shares in what they call qualifying companies. Those are large companies that pay the full tax rate. Now, if you're wondering why does it pay a lower tax rate? Because remember, dividends come out of after tax profits. That tax has already been paid. So everybody says, well, you know, dividend people don't pay taxes. They don't, somebody else pays them. However, and then the last example is like fully levered. They only put $50 down. You pay $38. You still got the gain of $80, and so you have 84% return. That's like leverage like crazy. You borrowed almost all the money. You'd have to borrow that from your mortgage-backed line of credit. Unfortunately, when the lever turns the other way, so in this example, we lose 2% just buying the investment. Stock, you know, we have a yield, but the stock price drops by 5%. We lose 2%. If it's 50-50 levered, we lose 8%. If it's as near as down at 100% levered, we lose 116% of our investment at only $50. So the lever amplifies the losses and the gains that you will have. And that's why they don't like you to borrow more than 50% of the value of the stock, because then there's enough wiggle room that you can sell it. Now, if you have what's called a levered account, it means you can borrow money against your stocks. And you can do that, but if you get too close to the line where the value of your portfolio drops, they will sell some of your stocks for you. And usually that happens when the market's going down. And so a lot of stocks are getting sold, and it exacerbates the downward trend on the market if people are buying a stock on margin. It's called buying on margin. So you have a margin account. You're levering it through your margin account. And if all of a sudden everything goes down and it triggers a bunch of sales, things go down, it triggers more sales, really, really quickly. One of the reasons, if I did lever, I would never lever more than a quarter of the value. But that, again, negative bill over here, because I don't do it at all myself. But when you see, when leverage works good, it goes, oh yeah, let's take our mortgage-backed line of credit and invest all that money. Again, it can backfire on you. And again, markets are a little high right now. I'm not convinced this is the time to be putting things into anything overly risky.
I was just gonna, like, would you only leverage buying individual stocks? Like, you wouldn't
I would,
leverage to buy these funds?
I would actually, that is the one thing I would leverage to buy. I would lever to buy something like SOT, ZWU, not ZWB, it's not paying enough. HDIV is another good one because they pay a lot and they will cover, you can basically pay them off. They're going to cover their own costs and then some. But again, the beauty is I write off the interest as if it was income, and I write on the return, in many cases as a dividend or a return on capital, which is not taxed because they're giving you your own money back. So there are some very high yield, and there are a couple of very good, they're not as high as they were because people have started to find out about them. But if you can, it used to be easy to borrow at 4% and get 6 and 7% return. However, here's the problem: as interest rates go up, your borrowing costs are going to go up. And so you could get caught, your stocks doing okay, but all of a sudden your carrying costs are going to go way up. They're going to change the leverage. So again, it's risky. And because we're in volatile interest rate times, and I think volatile doesn't mean this, I think volatile means that's a technical financial term.
What's that right now?
What's this is RBC Prime is 3 point something, 3.4, 3.5. But they expect it to go up again the next Bank of Canada. Everybody's expecting another 0.5% increase. I mean, they could be wrong, but now sometimes we don't necessarily want to put our money into Canada. Canada only represents 3% of the world economy or the world stock market. So we put money into other things. The problem when you're buying foreign stocks is you're taking 2 risks. So if you buy shares in a US company, say you buy some shares in Microsoft or Apple, you can make or lose money because the stock goes up or down, but you can also make or lose money because the Canadian dollar relative to the US dollar. So if you had an American stock today, Canadian dollar went up, you actually lost a little bit of money on the exchange rate from the US dollar today, because today's dollar happened to gone up a little bit. The other thing is, when you get a foreign dividend, so when I have a few, just a little tiny bit of US stuff that produces dividends, you actually pay a 15% withholding tax to the IRS, but you get a matching tax credit. So you don't pay the tax twice, because we have a reciprocity agreement with the United States when it comes to foreign income investment. There are ways, again, with exchange traded funds that you can mitigate this, because sometimes you'll look at the exchange traded fund and it'll be, let's say we're looking at, I'm very familiar, or more familiar with the BMO stocks. There are equivalents in all the other groupings, so don't think that BMO's any better. They were early and I know them a little bit better. But you can have one that would be, say, the Dow Jones fund. And then you're basically buying the Dow Jones. I've got the S&P before I bought the Dow Jones. Dow Jones is only 30 stocks. And then they've got the same thing, and it will say hedge to the Canadian dollar. And what they do is they buy currency futures, which I'm going to talk about in just a minute. We'll talk about futures in just a minute, that mitigates the exchange risk. So you get a little bit lower return because they have to buy this kind of insurance against changing dollars. So if you know you want Canadian dollars, but you want to be exposed to the American market, you can expose yourself to the American market by buying a hedged fund, and that hedged fund will be in consistent Canadian dollars. So you're taking away very people with very large portfolios, and I mean like in the multi-millions, not like the big ass ones. That's the technical term. Technical big ass portfolio. So look it up. They will actually buy currency futures to hedge against that. They can also, you can buy stock futures, puts and calls that mitigate your risk. My son invests, but he has a little bit of trading. He has a little bit of money. He just wants to have a little bit of fun with it. And he was at work. He's in film and television, and everybody was going on about ANC. And he goes, when everybody's buying, something's got to be wrong. And he short sold it, where you borrow stock and you sell it, and then you have to buy it back later. And if the stock goes down, then you buy it back. So he made money shorting it because he was just convinced that these meme stocks wouldn't stay doing what they were doing forever. And a couple had done that, and ANC was one of them. ANC was really smart though, was when everybody started buying the stock and pushed the stock price up, they actually did a stock up. They issued stock and got some cash in their coffers, which was pretty smart. So ETFs and mutuals, some mutuals use hedging strategies. And like I say, in my opinion, if your portfolio is under $500,000, you should be using mutuals and exchange traded, mostly exchange traded funds, to get the diversity that you can't get until you're at that level. And you know, honestly, if you're not willing to spend all your time studying like your brokers will do, get somebody else to do it. I do that. Most of my portfolios don't have that, except for she did that.
We all make mistakes.
Yeah. So there's a few advanced things, and I've got about 7 minutes left. Any questions at all about foreign investing? I'm not an expert in foreign investing. I'd stay away from countries that, I would stay away from any country that's not in the G20. But again, that's me being a bit risk averse.
We actually have another question about REIT.
Okay, REITs.
REITs.
The cool kids just call them REITs.
REITs. Okay, now
You are one of the cool
now I
kids.
know. How do you think the announcement the government made, such as prevention of foreigners buying houses, will affect REITs?
Not at
REITs?
all.
Oh, both in the short and long term?
Not at all.
And so is it a good time to invest in REITs?
Well, it's hard to know if it's a good time to invest in anything. I think it is. I think there's some really good REITs. I've never heard of a REIT that's residential housing. Or like houses. There are REITs that are apartment buildings that are for rental.
Mhm.
And I don't think as long as you're gonna continue to rent, I don't know that that would be impacted by foreign ownership.
Mhm.
But, in terms of condos and houses and townhouses, REITs don't play in that game. They play in the office building, like they say, they do have residential, but they're
Mhm.
built for purpose apartment buildings. So I don't see that having any impact unless the government decides to expand that to other forms. And the interesting thing is, I don't think that even with what the government's doing now, even if a foreigner can't buy it, that doesn't mean a foreigner cannot buy part of the trust that owns it,
Right.
right? And so, because remember, the real estate investment trust is in and of itself a trust,
Mhm.
which is why they distribute most of their returns. I don't believe that there's any reason. I could be wrong. I mean, that's an opinion question rather than an absolute right, wrong question. I don't see how it would, but I mean, maybe there's some economist out there who can figure out a way that it is, but that's not. It's a good question. By the way, government intervening in the housing market is.
Yeah.
It never does. I remember when they originally brought in the housing tax under Bill Vander Zalm in the 1980s, it was to prevent speculation.
Mhm.
And as Dr. Phil would say, how's that working for you? There are all kinds of other fancy forms of investment. I am not a fancy guy, and maybe it's either my age, lack of understanding, or the fact that when you're 65, you don't take the same risks as you do when you're 25. Bitcoin or Ether or ETH, that's what the cool kids call it apparently. I don't see it. There is one that is directly related to carbon credit. There may be something behind that. But as far as these NFTs, a lot of people think that the NFTs are just being pushed by people that are already in crypto, because you have to buy crypto to get your NFT. So my thought was we were going to change it and we were going to have an NFE, a non-fungible Eileen, because she's 91, and this would allow us to preserve her in cyberspace. I've got a niece who's an artist, so maybe there'll be a non-fungible version of my mom someday. I don't get why you would buy an NFT of a LeBron James slam dunk when you don't own the intellectual property for the LeBron James slam dunk. I don't get it, but apparently that LeBron James slam dunk, if you owned it in the metaverse, you would be the only one able to watch it in your meta house in the metaverse in Ready Player One, and you would own intellectual property within the metaverse. Other than that, if you've got money to burn, go for it. And there are people making money. But as I like to tell people, I know a girl who I went to high school with, and I think the year after graduation, she won $1 million in Lotto Canada. That would be back in about, I think she won about 75 or 76. And I know of other people that have won money in lotteries. I don't put them in my RSP portfolio, and I don't recommend them. Just me. That's just me. I like Warren Buffett's attitude. He says, I don't invest in things I don't buy. It doesn't mean they aren't good. It just means I like to buy where I'm comfortable. And I'm a bit the same way. But again, you know, if you've got extra $1,000 and you want to put it into Ethereum and it's not going to break the bank, go for it. Just as long as you understand if that part of your portfolio that you're trading is almost like your gambling money, and you have that mindset going in, then that's fine. It's like going to Las Vegas with X number of dollars, and when you run out of that, you go see Barry Manilow instead of gambling. Or Penn and Teller.
Not Celine Dion.
She's not there anymore.
A gal can dream.
Now she's fallen. She used to be here. Now she's fallen. One of my favorites is commodity futures. And commodity futures apparently go back to the 1600s in Japan for price. And what a commodity futures is, it actually is something that makes a lot of good economic sense, but now it's become something more. So let's say we have a brewery that needs barley and a barley grower that needs to sell barley. They will make a deal, a contract. And they say, I will give you X dollars per bushel, guaranteed for your barley. And what the brewery gets is they now know what their cost of their inputs are going to be. And what the barley farmer gets is she knows exactly how much she's going to get per bushel. She knows how much she's going to come, and if her crop gets wiped out, that's why there's insurance. So now she can go to the bank and say, here's how many acres I got, here's what my average yield is, and here's what I'm going to get for that. And the bank can go, we can take security against that. Here, we will lend you the money to plant your barley crop so that there will be beer for all and Whistler will be a better place. But then what happens is people would sell contracts. Now, in that example, it's a contract. If you have a contract, you are getting the barley. And so what you'll sometimes see, if you ever pay attention to oil prices, it'll say West Texas crude 3-month delivery. And what they're saying is that's the price per barrel for that commodity delivered in the future. And so a lot of the airlines, what they will do is they will buy forward so that they have certainty, so that they can sell you your ticket to Mexico in December. And if the price of fuel oil goes up, it doesn't matter because they are locked in and they know what they're going to pay for that fuel, so that they can, with certainty, say, yes, we can charge you, $483.70 for a flight from here to Puerto Vallarta, as opposed to buying that and going, hey, I'm sorry, we have gas prices went up. We need to charge you more. That gives you that certainty. So there's some real values. But then what happens is people can trade them. So in addition to that, you can have options. So you can have an option on something where if it goes to a certain price, you either are forced to sell it or you can buy it. But if it doesn't go there, if it doesn't hit this thing, it's called the strike price. You don't have to do it. And that's how these exchange traded funds work, is what they do is they say, we're going to sell call options, which is an option to buy. They sell somebody else an option to buy. They sell it. If the Royal Bank goes up to this much, it's neutral. But if it goes up to here, we'll sell it to you here, even if it goes beyond that. We're going to give up some potential capital gain, but you're going to pay us for the privilege. And that amount that they pay you is added to the dividend, and it gives you a better return. So when you buy a covered call, you're giving up some potential upside capital gain to get a higher monthly return. So in the banking one that I was telling you about earlier, ZWB has a covered call attached, and I think it's ZWC. There's the same thing, but there's no covered call attached, and it has more potential for capital gain. And they're identical or almost identical otherwise, except for one has futures. That's what the futures market looks like. I do not play the futures market with the exception of the covered calls that somebody else is doing all the work. I understand what it is. And again, this is how you can protect yourself, because you can buy currency futures. That's how you protect yourself against currency fluctuations. You can buy all kinds of different futures in all kinds of different things. And it's not that I expect you to buy this stuff, but I do expect that you might have an understanding of it if it comes up. Buying puts, which is an option to sell. Calls are an option to buy. With the covered call, they're actually selling the call, they're not buying the call. I'm not really confused. But you can buy agricultural commodities. Spring wheat is a good example of that. And the Canadian futures market for wheat, of course, because the Ukraine, no, sorry, it's not the Ukraine anymore, Ukraine. So Ukraine and Russia are amongst the biggest exporters in the world. But who's going to take advantage of that? Canadian wheat farmers, because they're going to be expecting to get more because commodity prices are going up quite substantially because of potential shortages due to the war in Europe. And Canada produces and exports a great deal. There are futures for livestock, and the Chicago Mercantile Exchange and the famous pork bellies. When I was a kid, they had these, and there was always the guy with the stock ticker, and they were yelling this nonsense back and forth. And for some reason, it was always pork bellies. It was always pork bellies. I have no idea why. And in Canada, I believe that was at one time in Winnipeg. And in the US, the big commodity exchange was in Chicago, it was the Chicago Mercantile Exchange. Energy, you can buy futures in energy, and that again smooths out, you know, your flight to Mexico or your cost for electricity. Bonds, stocks, and even interest rates. You can buy interest rate futures. And if you want to learn a bit more about that and how it can go really south, there was a movie made called The Big Short, and there's a scene in The Big Short with Selena Gomez and Richard Thaler. And they're explaining how the guys are playing blackjack and the guy behind them says, I bet this guy's gonna win, I'll take that bet. So it's a $10 table and the next guy's bet $100. And then somebody standing behind those guys says, I'll bet $1,000 this guy wins. Okay, I'll take your bet. And as they go back in the crowd, it gets bigger and bigger. So there was something that, and it's got a lot of, again, there's a lot of veracity in what they're doing, but at the same time, it's become very much a market in and of itself. And as I say, I kind of understand it and don't play it. If you have any complex questions on commodity futures or any other forms of futures, I try to answer them, but it's not my field of expertise. But I just thought I should mention it. And then there's some other neat things like collectibles, and I love those. So I'm done. You know, I like what Shakespeare said, to thine own self be true. I'm a big believer that, you know, you have to take care of yourself. And to people my age that have kids, I give you a warning from experience from other friends of mine. Don't give up your retirement for your kids. A lot of people think because they've got wealth that they've been building up for years, they've got plenty of money to give away if somebody's this, that, or the next thing. The reality is, with life expectancies going up, you probably need that money. And there are parents out there right now that are sacrificing their futures for their kids. Believe you me, the same kids that are going to take money from their parents are not going to be the same kids that are going to take their parents in their side. To thine own self. Maybe I'm an old grumpy cynic. In which case, I'm an old grumpy cynic. Control your spending. Develop a budget. Determine where you are today. Set debt reduction goals. And again, remember our 50 shades of debt, that tells you where to reduce. And you know, if you've got tax deductible debt, that's gold. If you got a mortgage, I have no problem with that. If you're borrowing money for lottery tickets, see a professional. Start saving a little bit each month. Once you've got your emergency fund, start thinking about investing. Start with either the new thing that replaces they're not calling it the RHOSP, but it is. Or your tax-free savings account. For most people, that's a better starting point than your RSP, even though everybody goes on and on about RSPs. In fact, I wish that when I was 18, they had TFSAs, and I put everything in TFSAs with one exception. But they've all got a space, but start with your TFSAs, because you can take that money out if you need it. That's why I'm a bigger fan of that. If you're making over $80,000 a year, ignore what I just said. And drop yourself into the next tax bracket with your RSPs, then put the money into TFSAs. Take the money you save from the deduction, use that from your TFSA. If you're under, I think I worked it out, was $72,000 tax limit is the break-even point. If you're below that, TFSAs, pay the tax, put money into TFSAs. But the homeowner plan, they work out the details on that. I may have to add that to next year.
So that would be for the 2023.
I don't know. The minister only announced it conceptually. I don't believe that the budget has passed and they've got the details worked out. I would think it's 2023, but she may make it retroactive to 2022. I don't know. I don't.
Very good.
I was disappointed that they got rid of it back in the 80s. I thought it was a really good saving vehicle for people, but they. That's all I've got. Are there any questions? Because I hear that I talked about beer and barley, so I was calling my name.
The bell has been rung.
Commodity.
Yeah.
Yeah, so that's because there's no commodity for marijuana that I know of. Otherwise, I'd pick something Whistler specific today.
Anybody on Zoom with any other questions, my friends?
No, they've got my contact info, right? So if you've got a question after the fact, don't hesitate to shoot me an email. Remember, after the seminar, I promised you I would never lie during the seminars, but afterwards you're fair game.
And I will send out this recording, so don't feel like you have to memorize everything that we learned tonight.
And there's no exam.
There's no exam, hallelujah, except life. Um, All right, we have some friends saying thank you. Thank you, friends on Zoom.
Thank you so much. That was fantastic.
Hope you had
Well,
some
thank
fun.
you.
Try to
Yeah, we
make
did have
finance
some fun, didn't we?
I try to make finance fun.
You accomplished that, I must say. Okay, if there are no other questions, I am going to stop our recording.